What's up, Banter fam? I'm your host, Miles, and today I'm going to be talking about the Ethereum Merge. Is it fully priced in? Is the recent rally that we saw simply a fake out? Or is the true value of the merge not yet priced into the market? I'm going to be discussing the four major variables that have arisen recently, from whether the ETH merge will be delayed, the pricing of a proof of work fork, and then OAFC risk following the Tornado Cash sanctions. It's going to be a massive show, and at the end of the show, I'm going to arise to a thesis whether I think the Ethereum merge is fully priced in, or whether we've already seen the potential top for Ethereum heading in to one of Ethereum's major events in its history in September. Let's get straight into the show. The first thing that I think we need to look at is the Ethereum price. We know that in the hype to this merge, which is slated to be on September 15th, we've seen a major run up in the price. This resulted in us hitting the $2,000 level. Now, since then, we have cooled off a little bit back down to the 1550 level. Now, the real question on everyone's lips right now is this simply buy the rumor, sell the news event? Is this Ethereum merge simply one big fake out? And is this recent pullback the beginning of a shift in the structural demand for Ethereum as an asset, which is reflecting in terms of technical analysis? Now, I'm going to do my best to answer that question in today's video, but I think the important thing from a price analysis perspective in terms of TA is that we are still sitting in this key zone from 1538 to 1634. Now, Bitcoin is looking quite shaky. It is in the bottom of its diagonal channel on the 6-hour and the 12-hour. However, if we can hold that channel, it is poised for a bounce in terms of where we sit structurally, because we know there is a lot of liquidity and buy orders coming in this zone. If we did, however, drop this zone, we still have that key level of the 1420 to potentially bounce off. Obviously, if you come back down to these 1280 levels, then the entire pump is essentially at that point erased, and structurally that starts to look quite damaging for Ethereum as an asset. But right now we are still I guess in the macro bullish pattern, although it's starting to look very shaky. So we do need to hold this level in order to affirm positive price momentum headed into the merge. Now, if you do want to trade, remember, we do have the trading competition still in progress. I'm battling away. I'm trying to make a bit of a comeback after a slow start in the first week. And if you guys sign up for Banter BYBIT account and claim your $4,200 bonus, then you can take part in the competition, where you could potentially win up to $10,000 if you finish first place. And there's currently $50,000 worth of prizes on the line. It's been a lot of fun. You only need $250. So if you are interested in having some fun trading, obviously, do so at your own risk, and make sure to be smart with leverage during these volatile times. But you can do so via signing up using the link in the description to a Banter BYBIT account. But what is this? All this talk about the Ethereum merge. What variables do I think can affect the Ethereum merge pricing heading into the merge in September? Well, there are kind of four main ones at the moment. Now, in order to frame this, you have to go back a couple months ago and look at the major topics that have arisen in the market. Now, the first question everyone had leading up to the merge, probably in July and then going into August, was, will the ETH merge be delayed? This was seemingly the biggest risk and the biggest variable, and still is one of the biggest risks when it comes to pricing the Ethereum merge. The major question on everyone's lips was, well, the Ethereum Foundation has notoriously been slow with shipping code, and we've continuously seen delays and delays. So will this just be another delayed event? Well, now I think we're starting to see that shift a little bit, because they've been pretty firm on this September 15th date. Does that mean it can't be delayed by a week or two? No. And I think the market, to some extent, does price in the likelihood of a slight delay. However, this narrative started to shift in early August to, well, what about a proof of work fork? What percentage will a proof of work fork actually constitute? And this was the next major variable that was being discussed quite heavily by people. Will it make up 5 to 7% of the chain? Will it make up 3 to 4% of the chain? Currently, it's only being priced at a few percent, because we've seen multiple dApps and applications, even USDC, even Aave, even Chainlink, come out and say, well, we're not actually going to support this proof of work chain. Even if it does get backing from the miners, a lot of the major dApps have decided not to support it, which likely indicates it won't get the traction that some thought it may. It's still an interesting discussion, but that was, the major next variable that was on everyone's lips at the start of August. Then the next variable that came out of nowhere seemingly was this Tornado Cash sanction. We saw, obviously, Tornado Cash sanctioned, meaning that users that interacted with the smart contract were at risk. And a lot of people obviously stopped using Tornado Cash. We saw the developer was actually sanctioned for helping develop the the code, and this raised some questions about whether OAFC risk could actually start to affect a product like Ethereum or the staking derivatives on Ethereum going forward. I guess this is a systemic risk that we hadn't previously considered before, or I guess seemed foreign to us, that is now seeming like a real concern. That was kind of the next big variable that arose. And then now the narrative has shifted again to what will the post yield on the merge actually be? So after the merge, how much yield will you actually be able to earn on your Ethereum? Because that is one of the main fundamental drivers of how we price this ETH Merge narrative. Because stakers, especially big institutional clients, will do their cash flow models based on the amount that they will receive back in Ethereum tokens. And also this increases retail demand for staking, as higher staking rewards tend to lead to more stakers because it attracts liquidity. However, with recent rumors that the yield could be closer to 4% than the previously expected 7.5 to 10%, does this take a fundamental hit on the Ethereum merge? Well, I'm going to answer what I think the ETH merge yield will be in today's video. So the first point to note is that the official transition from proof of work to proof of stake does two main things. It decreases Ethereum's energy usage by over 99%, and it also sees ETH issuance decline by 90%. So essentially what this does is it paves the way for ETH to become deflationary after being historically an inflationary asset on proof of work. Given the new proof of stake mechanism, ETH tokens are required to stake to validate the network. That's how proof of stake works. You have a bunch of validators. You require people to stake their Ethereum tokens in order to validate transactions on the network. Whereas right now on proof of work, you need miners to mine Ethereum on the proof of work consensus mechanism to validate the network. Two different sets of validations. One opens up the door for staking, which is why this new economy for staking is one of the major talking points when it comes to pricing in the value of the ETH merge. Now, back in March, the expectation for these staking rewards was between 7.6 to 10.2%. The model below dictates this, that on a 7-day basis, based on current fees back in March, that 7.6% was the expectation. Even I did a video on this. I said it was around 7.5%. 30-day yield was 9.1%, and 90-day yield was 10.2%. Remember, this is annualized, so it's based on 90 days scaled up to an entire year. So a 10.2% yield on Ethereum post-merge would be very, very strong. But the issue is that there's kind of been a lot of talk, and rightfully so, that these expectations were too optimistic and that we would see an essential taper off post-merge where the yield tapers off from around 10.2%, potentially back down to even lower levels. Now, research analyst Dunleavy estimates Ethereum yields to generate between 7.14% on day one. So he did a financial model which indicates that the real staking yield of Ethereum could be anywhere from 6.8% on the conservative side all the way up to 13.7% on the very aggressive side, with his base or average case of 9.9% post-merge. But this is based on absolute numbers, based on the current amount of demand for Ethereum stakers and the current issuance and gas fees being burnt on the Ethereum network. Now, since this is based on current data, it doesn't factor in the future amount of stakers and the future participants that will be entering the market and staking Ethereum. Because the more people that stake, the more the yield is essentially diluted. And the less fees on the network, if there were to be a downturn in fees due to a multitude of factors, let's say the macro environment being one of them, that would result in lesser fee generation as well on the other side of things. So you kind of get this two-pronged balancing effect, which could result in a taper off essentially in yields. So then the question becomes, okay, we probably can't expect a 7 to a 14% yield on day one, but maybe we could expect closer to something like 5%. So Northrock, or Hal Press, said that he does expect a 5% yield post-merge, annualized based on a 12-month basis post-merge. That is the figure that he thinks you can expect as true yield. So not including, obviously, inflation in the economy, which is a separate argument. Ethereum will pay back, denominated in Ethereum tokens, a true yield of around 5%. Now, Jordy Alexander argued with this point, and he did not agree with this point, and he said he actually called Hal Press a maxi. He said, imagine being so brainwashed, you try to insult someone who doesn't toe your party line and yourself own instead, and then basically flat out said that he disagreed with the 5% true yield post-merge because he's expecting 3.5 to 4% pre-inflation, around 3% minus inflation, or around 2% tapering off minus significant inflation in the second half of 2023. So Jordy is expecting a base case of a 3.75 yield, 3.75% yield post Ethereum merge over the course of the year. He's expecting a taper down potentially even to 2.5%. And they had a debate about this, but I think it did raise some very valid points. And Jordy was so confident that he actually wagered North Rock $1 million if the yield was lower than 5%. So he's so confident to put his money where his mouth is. Now, in order to verify whether Jordy is closer to the money or North Rock is closer to the money, we can actually go into ultrasound and look at the current merge simulations. So if we simulate the merge based on the last week's worth of data, we could see a decline in issuance to a supply growth of 0.2%. Now, this is slightly higher than the all-time data, so factoring in the last few years of Ethereum at minus 1.6%. So we could expect post-merge, even on a 30-day basis, to see a slight positive supply growth. So not quite inflationary, but getting fairly close to being inflationary. And this indicates that the issuance can print essentially an APR of 4.6% based on a year's worth of validated rewards. Total being 8.9 minus issuance, we kind of arrive to a figure of 4.3 to 4.6%, depending on whether you use the yearly data, the 90-day data, or the 30-day data. So a 4.6% yield would be closer to Hal Press's expectations, but it doesn't factor in that major factor of the APYs coming down due to ETH fees and the amount of ETH being staked. So you can comfortably project that the amount of ETH staked will increase post-merge, but it's unclear where the fees will go based on demand for actually using the network. We know the merge itself won't have a direct impact on gas fees, and it will more heavily impact the deflationary side of things through the issuance decrease and also the energy usage. But it won't impact directly gas fees on the network. That is more due to total demand for the network as Ethereum continues to roll out changes over many years, and we're predicting it to be a multi-year process to actually scale Ethereum. So Lucas says 4 to 7% sounds reasonable, but it ultimately depends on network demand, which is why figures based on current validated rewards are slightly skewed, and that's maybe where North Rock is getting it slightly wrong at the moment. So why is this so important? Well, because the percentage that stakers will be earning for staking their Ethereum post-merge is a major dictator behind the cost basis model of working out what Ethereum's value is today. And it's one of the biggest variables or risks and benefits on the positive side to how we actually price in this Ethereum merge. In my opinion, I think we see probably a 7 to 10% post-yield target with a gradual taper down towards something closer to Jordy Alexander's targets of 3.75%. If I had to guess, I'm kind of going to weight this based on the ultrasound prediction of 4.3%, minus the fact that more staking participants will join the market, which probably scales it down closer to something like 4%. And I think the market is pricing this pretty close to 4% at the moment, with Lido, the main liquid staking platform facilitating liquid staking on Ethereum, currently offering 4.3%. So let's assume it is 4.3%. Is that over? Can we say that the Ethereum merge is accurately being priced in? Well, no, because there is another systemic risk that has recently arisen, and this is off the back of the Tornado Cash sanctions. This is a systemic risk that we weren't really previously considering a week ago because, frankly, it seems so absurd that it could even occur. But now the likelihood of this risk is starting to increase, and that is the risk of FOAC control over sanctioning Ethereum-related protocols. Why is this important? Well, 11.17% of total ETH is currently staked. Now, that's a number, as I previously affirmed, is only set to increase after proof of stake is initiated. Out of this 11.17%, we can see that that's the current staked share of ETH supply. So the total ETH supply that's currently being staked. Out of that percent, 31% is being staked through Lido, with over 30%, 32.6% allocated to liquid staking. It is the number one place to stake Ethereum at the moment because liquid staking essentially enables you to keep your tokens liquid because you get staked ETH as a receipt, keeping liquidity over your staked ETH to be able to do what you want with that, sell it, trade it, stake it in LPs, etc., earn additional yield on it, whilst keeping your base Ethereum locked. Now, this fundamental driver behind liquid staking has resulted in the percentages for this market significantly increasing, as we could see as per this pie chart here. In fact, liquid staking is more popular than centralized exchange staking, whale staking, and other forms of current staking. Now, I'm assuming the validator node percentage will increase post-merge, but right now, people are very interested in staking through liquid staking because of the benefits that that you actually adopt through staking through a platform like Lido. But there is a real regulatory risk which started to arise because the dominance of a platform like Lido puts Ethereum up for an element of risk if there were to be OAFC sanctions. So we know Tornado Cash was sanctioned off the back of expected money laundering on the platform, which resulted in many users being barred from using DeFi applications, users being barred from using Tornado Cash in the US. And the question arose that could institutions that were primarily based under the FOAC's US jurisdiction, like Coinbase and Kraken, who hold a large amount of ETH2 deposits, come under scrutiny if there was ever censorship at a protocol level? Now, although this kind of seems like a very minute risk or a forward-thinking risk, it has become more prominent over the last couple of weeks. And there was an amazing tweet, which asked a really tough question and said, if regulators asked to censor Ethereum at protocol level with your validators, because validators have the choice whether to keep running or whether to shut down, would you comply and censor at protocol revenue, which I guess kind of goes against the integrity of the Ethereum network, or would you shut down the staking service and decide to preserve network integrity? Brian Armstrong, the CEO of Coinbase, said, it's a hypothetical I hope we don't actually have to face, but if we did, he'd want to go with option B. He says, we've got to focus on the bigger picture. There may be some better options like a legal challenge, etc., which would create a new option as well that could help reach a better outcome. But he hopes that projects that hold these validators, if they were sanctioned, decide to shut down the staking service and preserve network integrity. So let's say that happens to Lido and Lido has to shut down their staking service. Well, that's a really scary thought. And although the scenario remains kind of unlikely, the ramifications of protocol level intervention could be massive for Ethereum, in my opinion. And because Kraken and Coinbase come under US jurisdiction, I think this was a systemic risk that we probably didn't have a few weeks ago that's now starting to become apparent. And it's the latest variable to enter the fray in terms of how we price in the Ethereum merge here. And I guess this has more structural impact on Ethereum long-term than it does on the short-term pricing of the merge, in all honesty. But it's a very interesting discussion, which has shifted the conversation a little bit because we know that the Ethereum merge is so narrative-driven, and it's become quite pertinent in the last few weeks. Very scary thought that a centralized body can impose a sanction to a smart contract via directly punishing users and developers itself. So we've seen these multiple narrative shifts time and time again with the Ethereum merge, which are affecting the pricing of the merge in the market. Now, I would say that Ethereum's price performance is largely macro dominant due to the cool off in the Nasdaq, and then also the ripping of the DXY, the dollar index, which we've seen recently break into highs over the last day. But overall, this weakening can also be slightly attributed to these risks that the market is now pricing in. So the question when we price in the merge isn't whether there are risks, because it's clear there are risks. That the four main risks I stated in this video are major risks which fundamentally impact Ethereum's pricing. But it's more of a question on what percentage weighting do you give these risks? What percentage is the market factoring in these risks versus the likelihood of these risks actually occurring? That is how you come up with an expected value, an EV calculation, to help determine whether something is or isn't a risk-reward play. So I think that all these factors are major variables, but the ECG impact of the post-merge energy reduction is something not a lot of people are talking about. And I think although there's been a lot of focus on these risks, the decline in energy usage by over 99%, which in my opinion makes it significantly more palatable from an institutional investment standpoint, is a major factor, because we're essentially going to see ETH yield not only compare to ulterior TradFi investments, but decreased energy usage, potentially a catalyst for increased institutional adoption. So I think although ECG is a secondary component to decreased issuance in terms of importance, because we know that the fee generation, the yield generation, and Ethereum becoming deflationary is the major narrative behind driving the merge, it's still an important variable, which I don't think the market is potentially pricing in to the extent that it could be. So we know the bear case, we know the bull case. The question now becomes, is the Ethereum merge priced in? Now, there was a great article by Bankless, which answers this question, and I highly recommend checking it out. You can Google Bankless, is the merge priced in? It has fundamental analysis based on, and we know Bankless is an Ethereum-driven platform, so we know they have some element of bias here, but I do think this article has some good points. The first point that they make is the merge thesis hasn't changed, irrespective of these new variables. They think that Ethereum is set to undergo a massive structural shift due to the revamped tokenomics and what the merge sets in terms of a pathway going forward. We know that the merge going to proof of stake unlocks the door for sharding. We know it unlocks the door to enhanced data storage and ZK rollups, etc. And although the merge itself doesn't directly impact gas fees, these future upgrades, which are only possible because of proof of stake, will impact gas fees and will impact the structural efficiency of the Ethereum network. So in terms of valuing ETH's merge importance long term, we have to factor in the fact that proof of stake does allow this structural shift to occur. And their thesis here is that the shift gives rise to large-scale structural demand for the asset, some of the largest structural demand that we've seen in asset history. In the short term, they see that positioning is actually quite light. So perpetual funding has remained negative for most of the rally since June, although we did see that major spike last month in open interest. There has been a major cool-off, major liquidations with over almost $1 billion of Ethereum holders being liquidated just over the past few days alone. And now there is more shorts than longs in the perpetual market. Now, I think this is mainly macro-driven, but we are starting to see a lot of VCs and a lot of funds starting to position out of ETH, kind of following this buy the rumor, sell the news mentality. We saw Gallo Capital shift from being extremely bullish pre-merge to de-risking pre-merge. Now, they did this around $2,000. It's a very different equation, de-risking at $2,000 than de-risking at $1,600. So they expect, and this is Bankless, when I say they're expecting a period of range trading as short-term sellers sell, and the sell flow is then digested by the structural demand and larger slowing moving into institutional accounts. Price action in this period is less predictable and depends on the macro environment. And I guess that really sums up the point here, that the macro environment is still a strong dictator of what we are seeing from the Ethereum merge's pricing in terms of the Ethereum price on the open market. Do I think that the Ethereum merge is personally priced in based on the data we're being presented? If we're talking short or medium term, because I'll get to the long term in a second, I actually would lean towards no. I think the sell-off has been quite strong. I think that there's a large chance we do see a rally, whether that is pre-merge leading in the week pre-merge, or whether that actually may be post-merge now that we've seen a pre-merge sell-off. That's also a likelihood. But I do get the feeling that the risk of an ETH merge delay may be slightly overpriced in the current market. Some of the FOAC fears, although apparent in the current context of socializing on crypto Twitter and social media, that's probably a longer term issue, so I wouldn't be pricing that in too heavily now. And the ETH yield, although slightly dampening compared to our previous expectations, is still decent at 5% compared to TradFi. Now, if it was closer to 3.5%, I think structurally that is a slight issue, but I do expect Ethereum yield to launch closer to that 7% mark, which at least in the short term, in terms of the driving narrative behind the merge, would be positive. But I know a lot of you are long-term Ethereum holders. So from a long-term perspective, you kind of can't pay too much attention to this stuff, because we know that the increased adoption of the Ethereum network, the increased structural demand off the back of EIP I-55-9, or aka the tokenomics upgrade that we're seeing from the Ethereum merge, this will lead to increased net inflows, which we've seen over the past year or so. And they should also be sustainable and consistent in appreciation compared with other tokens, hopefully for decades to come. So if you're a holder, the merge is massive. And I don't know why people are fading the merge on social media. Maybe this is because a lot of people have this short-term trading mindset at the moment. But if you have a time horizon anything longer than a year, you should be extremely comfortable, provided the merge goes through, because of the increased demand we are going to see Ethereum as an asset, not only from an institutional standpoint, but from a retail standpoint as well, due to the basic law of network effect, which Ethereum is still relatively in its early stages of, compared to something like a Bitcoin, as Ran alluded to last week on the show. Bitcoin is, it's in its third cycle. It's had that extra few years to gain network effect. Ethereum is kind of mirroring Bitcoin on a 3-year scale earlier to Bitcoin itself. The key takeaway from Bankless was the merge is not priced in. And although whether we can argue and squabble over whether this is the case in the short term, I would say in the long term, it's not. If all things are considered, all variables are considered, all risks are weighed up against the positives, I still see the increased institutional demand, the structural demand for ETH as an asset, and the network effect long-term, alluding to the fact that the merge can be a much greater positive than the market is currently giving it price for. But in the short term, this can also result in positive price performance as well. As I said, I would not be surprised if Ethereum does bounce back up to this $2,000 region. Now, could this be another mini sell the buy the rumors, sell the news event? Probably. And I'd definitely be de-risking if we started to head these levels. Not a financial advisor. Personally, that's what I'd be doing. But in terms of the guys out there that are holding long term, then Ethereum is an asset that you can sit pretty in based on the long-term factors that I discussed in this video. But I'm going to keep you updated based on what we see heading into the merge, assuming there's no delays, assuming it all goes through on time. That's a big assumption, but assuming that is actually the case, then I think Ethereum could definitely surprise us, because there's still a lot of skeptics out there, and I've seen the skeptics arise in full force over the weekend. Maybe it's due to the cool-off in price, which starts to cause a little bit of hysteria, but if the merge does go ahead on time, I definitely see this as something that still has runway for growth, even given the current macro environment, which, if you want to know more about that, Rand did a great show earlier in the day on that I would check out. So what do you guys think about the ETH merge? Let me know in the comments below. Do you think it's priced in? Do you think the market is adequately valuing it? Or do you think it's being underrated in the current market condition? I want to continue this discussion on my Instagram. So I'll be going live on Insta, also talking through my trades in the trading comp. I prefer to do that on Instagram just because, we can hang out a little bit, go back and forth, have a chat. So I'm live on Insta now. If you want to head across, link in the description to join the live stream there. I also do follow back some people that follow me over on Instagram. And yeah, make sure you smash the like button if you enjoyed this video. Subscribe if you're not subscribed. And I will also see you tomorrow at 7:30 p.m. EST. Peace out, everyone. Man, the stream's still running. Pal, what are you doing? I'm live on Instagram right now. I'm going to end the stream myself and give it 5 seconds. That's so funny. Someone said anyone else just like listening to his accent.